You know, every crypto project has this financial blueprint, what we call its tokenomics. And today, we're going to tear that blueprint apart, using the KimberLite token as our guide. We're going to see exactly how these projects are designed, from that first big idea, all the way to day one on the exchange.
All right, so every project kicks off with a big, flashy idea, a killer pitch. For KimberLite, it's a world fueled by e-diamonds. It sounds cool, right? High-tech, valuable, a little bit mysterious. It's meant to hook you. But what's really behind the slogan? Let's find out.
So that cool term, e-diamonds, it's all built on this idea called an RWA, or a real-world asset. And let me tell you, this is a huge trend in crypto right now. The concept is actually pretty simple. You take something real and valuable, like gold, a building, or, diamonds, and you create a digital version of it on the blockchain. This whole process is called tokenization, and it makes trading these assets way, way easier.
And get this, the market they're going after is absolutely massive. They're aiming to tokenize rough diamonds, an industry worth over $100 billion. Now, historically, this has been a super illiquid market. That just means it's tough to buy and sell stuff quickly, and it's basically been off limits to regular people. KimberLite wants to change all that.
Okay, so that leads us right to their core promise. Beyond the marketing hype, what are they actually offering you, the user?
Well, here's the breakdown. You can trade these digital e-diamonds or even own tiny little pieces of them called e-carats. This gives you access to the market 24/7, just like trading crypto. But the real kicker here, the thing that really stands out, is the 11.5% profit sharing for people who hold the token. That's a direct financial reason to be part of their ecosystem. All right, now we're getting to the real meat and potatoes of this whole thing, the tokenomics. This is the economic engine that makes the project run. Yeah, forget the fancy slogans. This is where you find out what's really going on under the hood.
So, what in the world are tokenomics anyway? The easiest way to think about it is like this. It's kind of like a country's central bank and its monetary policy, but for just one single crypto project. It sets all the rules for the economy. How many tokens will ever exist, who gets them, when do they get them, all of that is baked right into the code from the start.
Okay, the very first, most important number you need to know for any project is its total supply. For KimberLite, that number is 200 million. That's it. There will never, ever be more. And that finite number is absolutely crucial. It's the same idea as Bitcoin having only 21 million coins. It creates digital scarcity, and that's a huge part of what can drive value over time.
So where are all these 200 million tokens actually going? This handy chart breaks it all down for us. You can see the biggest piece of the pie, 44%, is set aside for ecosystem expansion. That's basically their war chest for growing the project. You also see slices for the team, for development, and for fundraising. How a project splits up its tokens tells you a ton about what they care about most.
Okay, see that 10% slice for fundraising? Let's zoom in on that. Before any project can take off, it needs money to build and grow. This next part shows us exactly where that initial cash came from.
So, all in, the project pulled in $3 million from its early backers. In the crypto space, that's a pretty solid number for an early-stage project. This is the cash they use to fund development, marketing, all the legal stuff, basically everything it takes to get this thing off the ground.
Now, they didn't just get that $3 million in one go. It happened in stages. It started with early seed rounds for the very first believers. After that, you have the IDO and IEO rounds. Think of these as the public launch events, right before the token hits the open market for everyone to trade.
And here's the really important part. The price went up at every single stage. The first investors in seed round 1, they got the best deal at 10 cents a token because they took the biggest risk. By the time it got to the public, the price had already doubled to 20 cents. This kind of price ladder is super common, and it's all about rewarding the people who believed in the project from day one.
Okay, so investors have their tokens, but does that mean they can just dump them all on the market on day one? No way. And this is where we get to one of the most critical pieces of any tokenomics model, the unlock schedule. This is all about controlling the flow of new tokens to keep the market from going haywire. This whole process of slowly releasing tokens is called vesting. And the main thing to remember is this. Vesting forces everyone to think long-term. Instead of getting this giant pile of tokens right away that you could just sell, they get unlocked bit by bit. It helps make sure everyone is working towards the project's long-term success. And all of these clocks, all these vesting schedules, they all start at the exact same moment. It's called the TGE, or the token generation event. Yeah, it's literally the starting gun for the project's entire economy. It is the official birth of the token and the moment that clock starts ticking on every single one of those contracts.
Now check this out. This slide is really telling. Just look at the difference between what an early investor gets versus a team member. The investor starts getting their tokens pretty fast, but the team? They get 0 tokens up front. Theirs are locked for 5 full years. I mean, that sends a huge message to the community, right? It says, we're in this for the long haul. Let's make this real with a specific example. This is the schedule for people who bought in the public sale. They get 10% of their tokens right away at the TGE. Then every month, another 15% gets unlocked until they have them all. This kind of slow, steady release is designed to avoid big shocks to the market.
All right, so we've covered the supply, where the tokens go, how they raise money, and when people get their tokens. So for this last part, let's put all those puzzle pieces together and see what this thing actually looks like on launch day.
So here they are, the big numbers for launch day. The token is going to list on exchanges for 22 cents. Now, thanks to all that vesting we just talked about, only 1.2 million tokens are actually going to be out there. You multiply those two, and you get what's called the initial market cap, just over 260 grand. But the fully diluted valuation, that's the value of all the tokens were out, is 44 million. Let's talk about that big gap.
The most important thing to get here is the huge difference between those two numbers. Think of initial market cap as the right now valuation. It only counts the tokens that are unlocked and can be traded. But fully diluted valuation is the what if value. What if all 200 million tokens were out today? That huge gap between them tells you exactly how many tokens are still locked up, waiting to hit the market in the future. So there you have it. That's the entire blueprint. We've looked at the economic engine from every angle, from the total supply right down to the day one numbers. The architecture is solid. But the big question, the million-dollar question is, can a digital diamond truly shine? Well, that's something only the market can decide.